All right, let's get into it. You hear public sector accounting standards, and I know what you're thinking. Your eyes glaze over. You start mentally scrolling through your TikTok feed. It sounds like the most boring thing on earth, right? Like watching paint dry, but the paint is beige, and the wall is in a windowless government basement. But stick with me here because this is actually a huge deal. We're talking about something called Ipsas 31. Ipsas stands for International Public Sector Accounting Standards. Think of it as the international rulebook for how governments should do their accounting. And rule number 31, that's the one all about intangible assets. Basically, it's about how a government accounts for all the valuable stuff it owns that you can't physically touch. Now, why should you care about some obscure accounting rule? Survive load shedding, navigate Karachi traffic. Because this is about transparency. It's about accountability. It's about knowing what our government actually owns and what it's worth. When a government, like Pakistan's, decides to adopt these standards, it's like they're finally turning on the lights in a room that's been dark for decades. Suddenly we can see everything. Ipsas 31 forces government departments to identify value and report all their valuable non-physical assets. It stops these things from being just vague ideas floating around in a file cabinet somewhere and turns them into concrete numbers on a balance sheet. So what exactly are these intangible assets we keep talking about? It sounds like something from a fantasy novel, like a sword of fiscal responsibility +5. But it's simpler than that. An intangible asset is something valuable that a government owns, but it doesn't have a physical form. You can't kick it. You can't drop it on your foot. It exists as a right. It exists as a piece of knowledge. It exists as a digital file. It's the ghost in the machine of government bureaucracy. The key criteria are pretty straightforward: identifiable, under the government's control, capable of generating future economic benefits or service potential. Let's break that down with some real-world Pakistani examples. NADRA, the National Database and Registration Authority, the massive complex software that manages identities for over 200 million Pakistanis. A classic intangible asset. Not physical but incredibly valuable and service-critical. Pakistan Telecommunication Authority (PTA), auctioning 4G and 5G spectrum licenses. They're selling the right to use a specific radio frequency. PARC, Pakistan Agricultural Research Council, a new patented seed variety resistant to drought. That patent gives the government control over that IP. Pakistan Television, PTV, broadcasting rights. The right to broadcast events has clear value. These are the hidden gems on the government's balance sheet. But for the longest time they've been treated like they don't exist on paper. A department might spend ₹1 billion developing critical software, and from an accounting perspective, that money is just gone. It's recorded as an expense, not as an investment in a long-term asset. Ipsas 31 changes that mindset. It forces us to see value beyond bricks and mortar, code, data, ideas. If we don't account for them properly, we can't manage them properly. Okay, so you're an accountant in a Pakistani government department. Your boss just came back from a seminar, all hyped up. Now you have to implement Ipsas 31. Where do you even start? Step 1. The identification game. Like being a detective, but for non-physical value. Ipsas 31 gives a 3-point checklist. Identifiable, control, future benefits or service potential. Can't tick all 3. Not an intangible asset. Let's dig into identifiable. This is the big one. It means the asset is either separable, you could sell it, license it, transfer it, or it arises from a contractual or legal right. Example, a Microsoft Office software license bought by your department. That's clearly identifiable. There's a contract granting the right. Compare that to good staff morale or an efficient team. Valuable, but you can't sell morale to another department. Not separable. Not identifiable under Ipsas 31. Next, control. Control means the government can obtain the future benefits and restrict others. Think NADRA's database software. The government of Pakistan has complete control. They decide who uses it, how it's updated, who can access the data. Contrast. General scientific knowledge in a public research journal. A department can use it, but they don't control it. Anyone can access it. Control equals sign having the keys to the kingdom. Finally, Future economic benefits or service potential. The so what test. Will it do anything for you in the future? Example, FBR's tax filing software has huge service potential. It lets millions file taxes online, making the process more efficient. If an asset doesn't do any of this, it's not an asset. It's digital clutter. Once you've played the identification game and you've found a winner, an asset that ticks all 3 boxes, you move to step 2, recognition. This is the moment of truth. This is when you officially welcome the asset onto the government's balance sheet. It's like a financial bharat. But like any good bharat, there are rules. You can't just put anything on the books. Ipsas 31 lays down 2 strict conditions for recognition. Condition 1. Probable future economic benefits or service potential will flow to the entity. Condition 2. The cost must be measurable reliably. If you can't meet both, no entry. Probable versus possible. Probable means more likely than not. Example. Ministry of Education buys an e-learning license. The platform will be used by students and teachers. So the service potential is clear and long-term. It's probable. Counterexample. Super early stage blue sky research for a teleportation device. Benefits speculative. Possible, not probable. Then it's an expense, not a recognized asset. Reliable measurement. You need verifiable cost evidence. Vendor purchase example. Bought software for 50 million rupees. Invoice proves cost. In-house development. Think Nadra software. Track direct costs, salaries of developers, materials used, fees for code libraries. Edge case. Donated proprietary dataset. Benefits probable, but acquisition cost 0. No active market to determine fair value. Can't recognize on balance sheet. Instead, disclose details in the notes to the financial statements. The goal of recognition is to put credible, verifiable numbers on the books, not to just make things up. So, you've identified an asset and you've decided to recognize it. Great. Now for the million rupee question, or maybe the billion rupee question, what number do you actually write down? This is step 3, measurement. And honestly, it's not a one-time thing. There's the initial measurement when you first get the asset, and then there's the subsequent measurement for every year after that. Initially, Ipsas 31 is pretty clear. An intangible asset should be measured at its cost. Cost principle, you record things for what you paid for them. It's simple, it's objective, and it keeps things from getting too creative. For a purchased asset, like buying a geographic information system software for urban planning, the cost is straightforward. It's the purchase price plus any other costs you had to incur to get it ready for use. This could include import duties, non-refundable taxes, and any fees for installation and testing. It's the total cash you had to burn to get that software up and running. For an internally generated asset, like the FBR developing its own tax portal, the cost includes all the direct costs from the development phase. Salaries for the development team, materials consumed, and any other expenses directly tied to creating the software. But, and this is a big but, you cannot include costs from the research phase. All that initial brainstorming and feasibility studying, that's an expense. After the asset is on your books, you have to choose a path for subsequent measurement. Ipsas 31 gives you 2 options, the cost model or the revaluation model. The cost model is the simple default choice. You take the initial cost, subtract all the amortization you've charged over the years. That's like depreciation, but for intangibles, and subtract any impairment losses. It's predictable and easy. Most Pakistani public sector entities will probably start here because it's the safest and most straightforward route. It avoids a lot of headaches and subjective judgments. The revaluation model is the high-fashion, more complex option. Under this model, you periodically remeasure the asset to its fair value, what it would be worth on the open market. But there's a huge catch. You can only use this model if there is an active market for the asset. For many government intangibles, like a custom-built case management system for the judiciary, there is no active market. You can't just go on OLX and see what similar systems are selling for. So in practice, the revaluation model is rarely used for public sector intangibles. The cost model is king. Narrator. You've done the hard work. You've identified, recognized, and measured your intangible assets. Narrator. Now it's time for the final step reporting. Narrator. This is where you pull back the curtain and show everyone what you've got. Narrator: it's not enough to just have the numbers. You have to present them clearly and provide context so that people, from auditors to parliamentarians to the general public, can understand what they are looking at. Narrator: Ipsas 31 requires a whole bunch of disclosures in the financial statements. The goal is maximum transparency. No hiding the ball. You have to show your work. Narrator: first, the basics. For each class of intangible asset, like software, licenses, patents. Narrator: the financial statements must show a reconciliation of the carrying amount at the beginning and end of the period. Narrator: this means you have to show the opening balance, any new assets you added, any assets you got rid of, any revaluation changes if you're using that model, the amortization for the year, any impairment losses, and the final closing balance. Narrator: it's a detailed play-by-play of everything that happened to your intangible assets during the year. It prevents numbers from just appearing out of thin air. Narrator: but wait, there's more. You also have to disclose the accounting policies you've used. Narrator: did you use the cost model or the revaluation model? What are the amortization methods and useful lives you've assigned to your assets? Narrator: for example, a government department might decide that its new accounting software has a useful life of 10 years and will be amortized on a straight-line basis. This information has to be spelled out in the notes. Narrator: this is crucial because it allows anyone reading the report to understand the judgments and estimates that went into the numbers. It's the how we got here part of the story. Narrator: and finally, you have to provide more narrative detail. You need to give a description of any intangible asset that is individually material. Narrator: if the government spent billions on a new national cybersecurity platform, you can't just have a single line item for software. You need to talk about it. Narrator: you also have to disclose any assets whose titles are restricted, and the amount of research and development expenditure recognized as expense. It's all about painting a complete picture. Let's bring this home. How does all this theory actually look when you apply it in the trenches of Pakistan's public sector? Let's walk through a couple of concrete scenarios. Scenario 1. The Punjab Food Authority, or PFA, decides to develop a brand new mobile app. This app will allow citizens to report unhygienic restaurants, track food safety licenses, and get public health alerts. They hire a team of developers and spend 20 million rupees over 1 year to build and launch it. How does Ipsas 31 apply here? This is a classic internally generated intangible asset. Is the app identifiable? Is it controlled by PFA? Does it have future service potential? So it's an intangible asset. Next, recognition. Is the benefit probable? Can the cost be measured reliably? So it gets recognized. On their balance sheet, PFA will now have an intangible asset of 20 million rupees. They'll then have to decide on a useful life, say 5 years, and amortize it by 4 million rupees each year. Scenario 2. The Higher Education Commission, or HEC of Pakistan, signs a massive deal with a global academic publisher. For 100 million rupees, they get a 5-year nationwide license that gives every university student in the country access to thousands of academic journals and ebooks through the HEC digital library. This is a purchased intangible asset. Is it identifiable? Is it controlled by HEC? Does it have service potential? So, HEC recognizes an intangible asset for 100 million rupees, the cost of the license. Since the license is for 5 years, it has a finite useful life. The most logical thing to do is to amortize it over that 5-year period. Using the straight-line method, HEC would record an amortization expense of 20 million rupees each year. So after year 1, the asset would be on the books for 80 million rupees. After year 2, 60 million. After year 3, 40 million rupees. After year 4, 20 million rupees. After year 5, 0. This accurately reflects that the value of the license is being used up over its 5-year term. It's a much more accurate picture than just saying they had a 100 million rupee expense in year 1 and 0 for the next 4 years. These examples show how Ipsas 31 transforms abstract government spending into concrete, manageable assets that can be properly tracked, valued, and reported over their useful lives. Okay, adopting Ipsas 31 sounds great in a PowerPoint presentation. But implementing it across the vast, complex, and sometimes chaotic landscape of Pakistan's public sector, that's a whole different ballgame. It's not a simple plug-and-play situation. There are some serious hurdles to overcome. The first and biggest challenge is a lack of capacity and expertise. Let's be real. For decades, government accounting has been about tracking cash in, cash out. It's been about budgets, expenditures. This whole world of assets, liabilities, amortization, fair value is new territory for a lot of public sector accountants. You can't just hand them the Ipsas 31 manual and say, good luck. It requires massive training programs, certifications, a fundamental shift in mindset. You need people who can distinguish between a research cost and a development cost. People who can assess the useful life of a complex software system. People who can build and maintain an asset register. This expertise doesn't grow on trees. The second major hurdle is data and systems. To properly account for an internally generated asset, you need to be able to track its costs meticulously. Many government departments are still running on outdated systems, or let's be honest, on Excel spreadsheets and paper ledgers. Trying to implement Ipsas 31 on that kind of infrastructure is like trying to run the latest video game on a computer from the 90s. It's just not going to work. There needs to be a significant investment in upgrading the IT infrastructure of the public sector to support accrual-based accounting. And finally, there's the challenge of political will and cultural resistance. Change is hard. The old cash-based system was simple, and people were used to it. Overcoming this requires strong leadership, clear communication about benefits, and a phased implementation plan. It's a marathon, not a sprint. So, after all that, we're back where we started. Ipsas 31. Intangible assets, amortization. I know, it's a lot of jargon. It's easy to dismiss this as just another bureaucratic exercise, another set of rules for the accountants to worry about. But that would be missing the entire point. This isn't just about accounting. This is about building a modern, credible, trustworthy government. It's about changing the fundamental relationship between the government and its citizens, from secrecy to transparency. And that is a very big deal. When the government of Pakistan properly accounts for its intangible assets, it's doing more than just tidying up its books. It's acknowledging the true value of its investments in technology, knowledge, innovation. It's creating a clear picture of what the state owns on behalf of its people. This allows for better decision-making. When policymakers can see that a specific software system is a multi-billion rupee asset, they are more likely to fund its maintenance and upgrading. It turns abstract spending into tangible, manageable assets. Ultimately, this all comes down to accountability. A government that follows international accounting standards is a government that is easier to hold accountable. Citizens, civil society, international partners can look at the financial statements and get a real view of the government's position. They can ask tough questions based on real data. Ipsas 31 provides the framework to have that informed conversation. It raises the bar for public financial management, and that's something we should all care about.